What if the moment you lost your freedom wasn't a war, wasn't a revolution, wasn't a coup? What if it happened quietly? In boardrooms, in private rail cars, on a remote island off the coast of Georgia? What if it happened in the language of stability, of progress, of rational modern economics, while most people were simply trying to live their lives? What if the cage was built so gradually, so patiently, over so many generations, that by the time it was finished, nobody remembered there had ever been anything else? Every transaction you make, every dollar you earn, every debt you carry, it all flows through a system you never voted for, never approved, and were never meant to fully understand. A system designed not to serve you, but to be served by you. 1913. That's the year. That's where the thread begins, or rather where it stops being a thread and becomes a chain. The Federal Reserve Act, signed into law on December 23rd, while most of Congress had already gone home for Christmas. And the men who might have stopped it, the ones with the wealth, the influence, the iron will to mount a real opposition, they had boarded a ship the year before. It was called the Titanic. But the Titanic is just one piece. One moment in a pattern so long, so wide, so meticulously constructed that it stretches back centuries and forward into your wallet right now, today, as you watch this. This is not a story about a ship. This is a story about money, about who creates it, who controls it, and who decided, long before you were born, that you would never be allowed to ask those questions out loud. Before we can understand what was taken, we need to understand what it was like before it was gone. Before we can grasp the architecture of control, we need to walk through the world it replaced, because that world has been so thoroughly erased that most people don't even know to mourn it. Go back to the early 19th century, not just in America, in Britain, in continental Europe, in the emerging economies of the New World. Money was local, messy, yes, imperfect, certainly. But local, a bank in Ohio issued its own notes. A bank in Virginia issued its own. These notes were backed, in theory and often in practice, by something tangible. Gold, silver, land, agricultural commodities in some cases. The banker knew his depositors. The depositors knew their banker. Accountability was geographic. It was human. Was it a perfect system? Absolutely not. There were panics. There were collapses. There were fraudulent institutions, wildcat banks they called them, that issued far more paper than they held in reserve. But here is what I want you to hold in your mind as we move forward. The failures of the old system were visible, localized. When a bank in Tennessee collapsed, it didn't collapse London. When a speculative bubble burst in Philadelphia, it didn't automatically trigger cascading failures in Paris and Hamburg. The system was fragmented, yes, but fragmentation, it turns out, is also a form of insulation. The deeper I went into the historical literature, not the textbooks, but the primary sources, the legislative records, the private correspondence of the men who actually built these institutions, the more I noticed something strange. The loudest, most persistent, most well-funded critics of local banking were never ordinary citizens. They were never farmers who had lost savings. They were never the small merchants who occasionally got stuck with worthless wildcat notes. No, the loudest critics, almost without exception, were the largest financial operators of their age, men who already commanded significant capital, men with connections to European financial houses, men who had everything to gain from the elimination of their smaller local competition. This raises a simple but critical question. If the old system was so chaotic and harmful, why were its most passionate opponents drawn so consistently from the top of the financial hierarchy? Why not from the bottom? I kept asking that question, and it kept leading me somewhere uncomfortable. 1694, the Bank of England is chartered. 1791, the first Bank of the United States. 1800, the Banque de France. 1816, the second Bank of the United States. 1876, the Reichsbank consolidates German monetary functions. 1907, the Panic. 1908, the Commission. 1910, the Meeting. 1913, the Federal Reserve Act. Look at that sequence again. not as a timeline of natural evolution. Look at it as a campaign, a long, patient, multi-generational campaign to answer a single question. Who controls the creation of money? Because here is what the textbooks tend to gloss over. A central bank is not merely a bank. It is not merely a lender of last resort, a stability mechanism, a technocratic institution for smoothing economic cycles. A central bank is the entity that determines how much money exists. Read that again. How much money exists. If you control the supply of money, the total volume of it in circulation at any given time, you control the price of everything, not directly, not with a memo or a decree, but inexorably, mathematically, through the mechanics of supply and demand. More money chasing the same goods means prices rise. Less money means prices fall. Expand credit and businesses boom. Contract it and they fail, not because they were badly run, but because the medium of exchange itself was made scarce. The official explanation tells us this power was handed to central banks because it was too dangerous to leave dispersed, too volatile, too prone to mismanagement by lesser institutions. But that framing conceals something I kept noticing as I moved through the historical record. When the power to create money is dispersed, held by hundreds of local banks, by governments, by competing institutions, no single actor can use it as a lever. No single decision affects everything simultaneously. The system is imprecise, yes, but it is also resistant to top-down manipulation, resistant to coordinated extraction. When that power is concentrated, held by one institution, or a small network of institutions operating in coordination, the lever becomes functional, and someone's hand is on it. That's where the pattern becomes impossible to ignore. This is where the physical evidence starts to speak. Go and look, really look, at the monetary instruments that existed before central bank consolidation. In American archives alone, you will find hundreds of distinct forms of legitimate currency, credit instruments, and monetary substitutes circulating simultaneously in the 19th century. Not just wildcat notes, not just fraudulent paper, legitimate instruments, silver certificates, gold certificates, treasury notes issued directly by the government, not by a private institution, by the government itself, backed by metal, redeemable on demand. And then, systematically, over a period of roughly 50 years, they disappeared. Not all at once. That's important. The erasure did not happen in a single dramatic sweep that might have provoked resistance. It happened in layers. First, conditions were created that made competing instruments less convenient. Then regulatory frameworks made them technically legal but practically difficult. Then quietly, legislation removed them from circulation entirely. Each step was justified on its own terms. Efficiency, standardization, stability. The language was always rational, always technical, always framed as being in the public interest. But ask yourself, who defines the public interest in monetary policy? And how do we know that the definition being used is accurate rather than convenient? The silver certificate offers perhaps the most striking case. Here was a monetary instrument issued directly by the US Treasury, backed by physical silver held in government vaults. It required no private intermediary, no interest payment to any institution. The government issued it, the government backed it, citizens used it. By 1963 it was gone. Gone, not because it had failed, not because it was producing instability. The official record shows remarkably little public demand for its elimination. What the record does show, if you read carefully, is sustained, quiet pressure from the banking sector over the preceding decades, pressure framed in the language of modernization, of streamlining, of bringing American monetary practice into alignment with international norms. International norms set, in large measure, by institutions whose own interests were directly served by the silver certificate's disappearance. The deeper I went into these transitions, the more I noticed the same absence, again and again, not just of the instruments themselves, but of the debate, the genuine public, fully informed debate that a decision this consequential should, in any functioning democracy, have produced. The silence in the historical record is deafening. If this sequence of events is new to you, if you've never been taught this version of monetary history, you're not alone. Most people haven't, and that in itself might be worth sitting with for a moment. Subscribe, follow along, because what comes next is where the pattern gets significantly harder to explain away. Let me explain as plainly as I can the mechanism that makes central bank control of money creation so consequential. When a central bank issues currency, when it creates money, it does not, in the modern system, simply hand that money to governments or citizens as a public resource. It lends it. Money enters the modern economy almost exclusively as debt. It is borrowed into existence, and debt, by definition, carries interest. This is not a conspiracy theory. This is a description of how the system actually functions. You can verify it in any central banking textbook, any Federal Reserve publication. The mechanism is openly described. What is less openly discussed is its implication. If all money is created as debt, then the total amount owed, principal plus interest, is always greater than the total amount of money in existence. The interest was never created. It was promised but never issued, which means at the systemic level, there is always more debt than money. Always. By design. What does that mean in practice? It means that, taken as a whole, the economy cannot pay off its debts without someone going bankrupt. For every loan that is repaid in full, some other actor in the system must default, because there simply isn't enough money in circulation to retire all outstanding obligations simultaneously. This isn't pessimism. It's arithmetic, and here is where the pattern repeats with unsettling precision throughout the historical record. Every major economic crisis of the modern era, the Panic of 1907, the Great Depression, the stagflation of the 1970s, the financial crisis of 2008, follows a recognizable sequence. Credit is expanded, asset prices rise, debt accumulates. Then, for reasons that are always presented as technical and unavoidable, credit is contracted. Money becomes scarce. Debtors cannot service their obligations. Assets are seized. Wealth transfers from the many to the few, and after each crisis, the solution proposed is always some version of greater centralization. More coordination, more power to the institutions already at the center of the system. Not less. Never less, more. I'm not saying these crises were engineered. I'm asking something more precise. Who benefits from the pattern? And who had the knowledge, the position, and the incentive to anticipate it? In November of 1910, a group of men boarded a private railcar at a New Jersey station. They used first names only. They travelled at night. Their destination, Jekyll Island, a private resort off the coast of Georgia, accessible only by boat, owned by a club whose membership comprised some of the wealthiest families in America. They stayed for roughly 10 days. When they left, they carried the draft of a document that would, 3 years later, become the Federal Reserve Act. This is not disputed. This is in the historical record. The participants themselves eventually wrote about it. Not immediately, not while the legislation was being debated, but years later, when the system was already established and the accounts could do little to change it. Senator Nelson Aldrich was there, Frank Vanderlip of National City Bank was there, Henry Davison of J.P. Morgan was there, Paul Warburg, a partner at Kuhn, Loeb & Company with deep ties to European banking houses, was there. Benjamin Strong, who would become the first head of the Federal Reserve Bank of New York, was there. Vanderlip himself, writing in the Saturday Evening Post in 1935, described the secrecy, the false names, the private railcar, the deliberate concealment. He described it almost with pride. The secrecy, he wrote, was necessary because if it had been known that bankers were drafting banking legislation, the public would have rejected it. Read that again. The The men who drafted the Federal Reserve Act concealed their identities because they believed, correctly it appears, that the American public would reject the legislation if they knew who had written it. That is not my interpretation. Those are the words of a participant. So I have to ask, what does that tell us about the nature of the institution they created? And what does it tell us that this admission, published in a major American magazine in 1935, produced essentially no lasting public outcry? The official explanation at this point tends to be, well, it doesn't matter who drafted it, what matters is whether it works, whether it's good policy. But that framing assumes the institution was designed to serve the public interest. And if the men who designed it concealed their identities specifically because they knew the public would object to their involvement, then that assumption deserves, at minimum, serious scrutiny. And here is where I want to pause, because there is a thread in this story that most monetary historians never pull. A coincidence, if that's what it is, that sits at the precise intersection of the Jekyll Island meeting and the passage of the Federal Reserve Act. Three of the most prominent opponents of a privately controlled central bank in the United States were among the wealthiest men in America in 1912. Benjamin Guggenheim, Isidor Straus, John Jacob Astor IV, all three boarded the RMS Titanic in April of 1912. All three died when it sank. Now, I want to be measured here. I want to be precise. The Titanic disaster killed over 1,500 people. It was one of the greatest maritime tragedies in recorded history. The causes, the iceberg, the speed, the insufficient lifeboats, the failures of communication are well documented. I am not claiming the ship was sunk deliberately. I am doing something more limited and I think more honest. I am noting that three extraordinarily wealthy, politically connected men who had publicly expressed opposition to or skepticism of a privately controlled Federal Reserve System were aboard the same vessel. That those men died. That the Federal Reserve Act passed the following year. And that the question of what those men might have done, might have funded, might have organised in opposition was rendered permanently moot by their deaths. Is that a coincidence? Almost certainly. Probably. The Titanic carried hundreds of wealthy passengers. The actuarial odds of wealthy men dying in shipping disasters were not negligible in the early 20th century. But here's the strangest part. When you look at the documented opposition to the Federal Reserve Act in the congressional record, and there was genuine substantive opposition, you notice something. After April 1912, after the Titanic, the organised opposition among the ultra-wealthy class seems to lose a certain coherence, a certain funding base, a certain gravitational centre. Maybe that's coincidence, maybe it's exactly what it looks like. Maybe the truth is somewhere in the space between those two possibilities, in a place we don't have the documents to fully illuminate. That space, that gap in the record, is where I find myself spending most of my time in this investigation. The Federal Reserve did not exist in isolation. No national central bank does. And that, it turns out, is itself a crucial part of the pattern. Within 2 decades of the Federal Reserve's establishment, a new institution appeared, the Bank for International Settlements, founded in Basel, Switzerland in 1930. Its origins are mundane enough on the surface. It was created initially to manage German reparations payments following World War I, but its actual function rapidly evolved into something far broader and more consequential. The BIS became the Bank for Central Banks, the institution through which the world's major monetary authorities coordinated their policies, shared information, and established common frameworks. It operated, and still operates, with a level of legal immunity that is, if you examine it carefully, quite extraordinary. It is not subject to Swiss law in the ordinary sense. Its premises are inviolable. Its archives are not subject to external audit in the way that national institutions typically are. The governors of the world's major central banks meet there regularly in sessions that are not publicly minuted. I want to be clear about what I'm describing. I'm not describing a secret society. I'm describing an institution whose existence is entirely public, whose general function is openly acknowledged, and whose specific deliberations are largely shielded from public scrutiny. Those are not the same thing. But they are also not unrelated. The evidence suggests something much larger than national monetary policy at work here. Because once the BIS framework is established, once you have a mechanism for central banks to coordinate internationally, the question of who controls a national money supply becomes considerably more complex. A central bank may be formally accountable to its national government, but if its governor is also accountable to a set of international norms and frameworks developed in coordination with other central banks through a process that is opaque to the public and to most elected officials, then the line of accountability becomes, to put it gently, blurred. Who, in that system, does the Federal Reserve actually answer to? The official answer: Congress, which created it and can theoretically restructure it. The practical answer: examine the last 100 years of monetary policy. Examine who has led the institution. Examine the revolving door between the Fed and the major financial institutions it nominally regulates. And tell me what pattern you observe. Not Congress, not the public, not elected officials who are routinely told that monetary policy is a technical matter beyond the appropriate scope of political interference. Then who? Let me show you another kind of erasure. Less dramatic than the Titanic, less cinematic than a secret meeting on a Georgia island, but in many ways more consequential, because it operates continuously, invisibly across the lives of ordinary people who never once chose to participate in it. Inflation. The United States dollar has lost, by the Federal Reserve's own figures, approximately 97% of its purchasing power since 1913, since the year the Federal Reserve was established. Read that again. 97%. A dollar in 1913 would purchase in rough terms what approximately $35 purchases today. The official explanation is that this is an acceptable cost of a dynamic, growing economy, that modest, stable inflation is actually beneficial. It encourages spending rather than hoarding, stimulates investment, keeps employment high. There is genuine economic theory behind that argument. I'm not dismissing it, but I am asking you to notice something. Notice who benefits from continuous, persistent inflation. The debtor who borrowed before prices rose, somewhat. The wage earner whose salary increases with inflation, in theory. But look at the empirical record of the last century and ask yourself, have wages for ordinary workers consistently kept pace with inflation? Have the savings of ordinary households maintained their purchasing power? And then ask, have the holdings of those who own productive assets, land, equities, capital, have those kept pace? Have they, in fact, dramatically outpaced inflation year after year, decade after decade? The deeper I went into the distributional data, the more a single pattern emerged. Inflation consistently erodes the stored wealth of those who hold savings in currency, while asset holders, those wealthy enough to convert savings into property, equities, and capital, are largely insulated from and sometimes directly benefited by the same process. In other words, the people least able to protect themselves from inflation suffer its effects most directly. And the mechanism that produces inflation is controlled by an institution whose closest relationships are with those most able to protect themselves from it. Not why, not when, not through which technical mechanism. How was that arrangement ever allowed to become permanent? One of the most consistent features of this investigation, one that I kept expecting to resolve itself and never did, is the systematic incompleteness of the documentary record at precisely the moments that matter most. The Jekyll Island meeting, documented retrospectively by participants never contemporaneously. The deliberations within the Federal Reserve's Open Market Committee prior to 2008, released under legal pressure with a 5-year lag. The private communications between Federal Reserve officials and the major financial institutions they were simultaneously regulating and rescuing during the 2008 crisis. Partially released years later, revealing the extraordinary scale of emergency lending that was never disclosed to the public or to Congress in real time. The BIS meeting minutes, not publicly released, the early records of the Federal Advisory Council, the body through which private bank executives formally advised the Federal Reserve, sparse, selectively preserved. I want to be fair. Government institutions everywhere have incomplete records. Archives are lost, mismanaged, destroyed by fires and floods, and bureaucratic neglect. I'm not claiming that every gap in the record is a deliberate act of concealment, but there is a difference between random archival loss and systematic opacity at the specific decision points where questions of accountability are most acute. And the pattern here is not random. The most consequential decisions, who gets emergency liquidity, at what rate, under what conditions, are consistently the least well documented, the most slowly released, the most resistant to external scrutiny. Not an accident. Not bureaucratic oversight, not random. The evidence suggests design. 1907, a banking panic, severe but manageable, is used to justify the creation of a national central bank. The argument, only a central institution can prevent future panics. 1929, the worst financial crisis in American history occurs, under a Federal Reserve System now 17 years old. The official conclusion, the Fed failed to act aggressively enough. The solution, more power to the Fed. 1971, the last formal link between the dollar and gold is severed. The money supply is now entirely at the discretion of the Federal Reserve, with no external anchor. The official justification, flexibility is needed to manage the modern economy. What is created, a system in which the volume of money is constrained by nothing except the judgment of an institution accountable to no electorate. 1987, a market crash. The Fed intervenes, markets recover. The lesson absorbed by every major financial institution, the Fed will act to prevent catastrophic losses for large players. The term that emerges from this era, the Greenspan put, the implicit guarantee that the central bank will backstop the system. And backstopping the system, it turns out, means backstopping its largest participants. 2008, the largest financial crisis since the Depression. Caused, at least in part, by risk-taking behavior that was encouraged by the implicit guarantee established over the preceding decades. The response, trillions of dollars in emergency lending, asset purchases, and direct recapitalization of the largest financial institutions, not the small ones, not the regional banks, the largest ones, the ones incidentally whose executives rotate most fluidly into and out of the Federal Reserve's own leadership structure. The pattern repeats with unsettling precision. Crisis, official explanation, solution that concentrates more power in the same institutions. Repeat. At what point does coincidence become something else? I want to take a moment away from the mechanism, away from the institutions and the legislation and the technical apparatus. I want to ask a different kind of question. What was lost? Not just in financial terms, not just in the narrow sense of purchasing power or institutional accountability. What conception of money, of wealth, of community economic life, what worldview was displaced when the old fragmented local monetary system was replaced by the centralized architecture we now inhabit? Because here is what strikes me most, the further I travel through the historical record of pre-central bank monetary life. In that world, messy, imperfect, crisis-prone as it was, money was understood as a tool created by communities to facilitate exchange, something that could be reformed, redesigned, replaced, something that belonged in a fundamental sense to the people who used it. That understanding has not simply evolved, it has, in a very meaningful sense, been erased, replaced by a framework in which money is technical, money is complex, money is the proper domain of credentialed experts operating in institutions buffered from political interference, which is to say, buffered from democratic accountability. And once you accept that framing, once you accept that money is too complex for ordinary citizens and elected representatives to meaningfully evaluate or control, then you have accepted something profound. You have accepted that one of the most fundamental powers in any society, the power to determine how resources are allocated through the medium of exchange, is properly held by people you did not choose, operating in institutions you cannot audit through processes you were never meant to fully understand. How did we come to accept that? When? And did we accept it exactly, or was it arranged for us? Here is perhaps the deepest anomaly I encountered in this investigation. The one that, once I noticed it, refused to leave me. The transition from dispersed, locally accountable monetary systems to centralized, institutionally managed ones did not happen in one country. It happened across the Western world, in roughly the same historical window, using remarkably similar institutional frameworks, articulated in remarkably similar language by men who, in many cases, knew each other, corresponded with each other, trained together at the same institutions, and moved through the same international financial networks. The Bank of England model was not merely observed and independently replicated. It was actively exported. Through technical assistance, through the movement of personnel, through the conditions attached to international loans, through the norms established at the BIS, through the Bretton Woods institutions established after World War II. By the mid-20th century, virtually every nation on earth had a central bank operating on broadly similar principles. Monopoly on currency issuance, partial government ownership combined with significant operational independence, the tools of interest rate policy and reserve requirements, integration into international monetary networks. The extraordinary uniformity of this outcome across cultures, across political systems, across genuinely different economic histories demands an explanation. The official explanation, because it works. Because central banking is simply the most efficient solution to the problem of monetary management, and efficient solutions tend to converge regardless of starting point. But that explanation assumes the point in contention. It assumes that what was created is, in fact, an optimized solution to a genuine public problem, rather than a highly effective solution to a different problem. A problem not of stability, but of consolidation, of ensuring that the power to create money rests everywhere, with institutions embedded in the same international network operating by the same norms, subject to the same invisible pressures. I cannot prove that. I want to be honest about that. But the uniformity itself, the speed of it, the completeness of it, that part is not speculation. That part is history. And it poses a question that the official narrative has never, to my satisfaction, adequately answered. How do you get the entire world to reorganize its monetary architecture within a single century in ways that consistently benefit the same class of actors, without some coordinating force that goes beyond the natural diffusion of good ideas? I started this investigation looking for a specific event, a moment of decision, a document that would reveal the mechanism clearly. What I found instead was a pattern. Long, patient, multi-generational. A pattern of gradual consolidation dressed in the language of rational administration. A pattern of crisis and response that consistently resolved in the direction of more centralization, less accountability, greater opacity. A pattern of erasure, of instruments, of institutions, of frameworks that left behind almost no record of what was lost or why, or who specifically benefited from the loss. And underneath that pattern, a question that I have not been able to answer and that I suspect cannot be answered from publicly available evidence. Was this designed, or did it simply emerge, as the official narrative suggests, from the natural logic of modern finance, the inevitable rationalization of a chaotic system by well-meaning technocrats? And here is the haunting thing that keeps me returning to these archives, these photographs, these fragments of a monetary world that no longer exists. I'm not sure the answer changes what we can see, because whether it was designed or whether it simply emerged, the outcome is the same. A system in which the power to create money rests with institutions whose deliberations are opaque, whose accountability to the public is indirect at best and theatrical at worst, and whose closest relationships are with the very entities they nominally oversee. A system in which ordinary citizens can vote for governments but cannot meaningfully vote on monetary policy. A system in which the most consequential decisions about the allocation of resources in society are presented as technical questions, questions above politics, above democracy, above the legitimate reach of the people most affected by them. Once you see that structure for what it is, you cannot unsee it. The world that preceded it, messy, imperfect, fragmented, is gone. The records of its operation are incomplete. The men who might have preserved a different path died, or were marginalized, or were simply outmaneuvered by patient, better organized, better funded opponents. What remains are the institutions themselves, their official histories, their curated archives, their approved narratives about why they exist and what they do and who they serve, and the questions that those narratives, no matter how polished, cannot quite answer. Who decided that money creation should be private? Who decided that the decision makers should be insulated from accountability? Who benefited from the silver certificate's disappearance, from the gold standard's dissolution, from the construction of an international architecture that made national monetary sovereignty increasingly nominal? Not when, not where, not under which technical framework. Who and why, when you start pulling at that thread, does so much of the documentary record seem to end exactly where the answer would begin?